friends, welcome to our monthly update on markets and investments. I hope each one of you and your dear ones and family members are safe. We all know that the second COVID wave was quite something, unlike the first wave, where we thought that our near and dear ones were not that impacted, but somebody very distant was impacted. However, in this particular wave, we all have seen that in some way or the other, the second wave has touched somebody in our families or somebody who's very close and dear and known to us. And therefore, I hope and wish that all of you are in the best of health and you're taking all the precautions that are important to keep yourself and your family members safe. Having said that, the good news is that the second wave is now receding, especially in Mumbai and Delhi, which saw a significant spike. We've seen a significant deceleration in the rate of net new cases. And I think that as these numbers come down, we will start to see that various states will start unlocking. But this time, in my opinion, because the second wave caught everybody by surprise because of the ferocity, I think every state will be very cautious in reopening, and you may not see a sudden reopening, but it would be a very staggered reopening. Secondly, I think the unlock will have a very positive impact on high-touch businesses. I believe that the impact on incomes and wealth is still uncertain. Maybe wealth not so much, but certainly incomes at the middle and the lower end are certainly impacted because the health costs have eaten into people's savings, and maybe it could have impacted their livelihoods as well. And sure, when things open up, there will be pent-up demand, which will need to be satisfied, which will give an impetus to the economy. But in our view, it may not be as sharp as we saw it last year because of the reasons that I mentioned, that A, this time healthcare costs have been significant. I think that as vaccination progresses, we will see a better and greater impact of unlocking. But I think the pace of vaccination is likely to be the most important factor going forward to instill confidence in people to go out and spend money, because in the second wave, it also happened that it really impacted people's morale and thought process. Especially you don't feel too good about the fact that your near and dear ones have got impacted. So I think as vaccination progresses, I think the confidence should come back very strongly. And despite all of this, I do remember that when the second wave started, there was again an expectation in the markets that the markets would correct quite substantially, but that didn't happen. And again, people were pleasantly surprised by the resilience of the markets. Yes, the markets did correct a little bit, especially again, the financials and the frontline COVID impacted sectors did go through a correction, but the overall market did not show any significant weakness, so to speak. And then the fallacy that has been going around that, these markets are going up only because of liquidity, in my opinion, is also not correct. Because if you look at the data, in Jan and Feb, you had net FII buying, but you had the domestic institutions which sold. In April, after March and April, when the second wave was at its peak, we actually saw foreign outflows rather than inflows. And FII flows have just turned positive in the last few days as our COVID cases have peaked. So the point I'm trying to make is that people trying to understand the resilience of the markets and saying that this has largely to do with liquidity, in my opinion, data doesn't show that it is only liquidity which is driving the markets. Yes, retail participation has continued to be significantly high. In my opinion, the biggest catalyst for the resilience of the market has been earnings. We've said this, earnings surprised us even after the first COVID wave in the second quarter of last year. And in the recently concluded fourth quarter, if you look at the numbers, yes, your YOY numbers will look very strong because last year, the last few days of March when there was a lockdown, and this year, relatively speaking, March was very strong. So a year-on-year comparison would not be right. But despite that, if you look at revenue growth for the Nifty companies, it was up 17% year-on-year. But more importantly, it was also up 14% quarter-on-quarter. Your EBITDA margins, your EBITDA, reported EBITDA was up 33% on a year-on-year basis. But quarter-on-quarter, it was also up 7%. And these are all for non-financial numbers. And PAT obviously was up significantly, 266% up. If you look at the total Nifty, which is not just the non-financials, but if you look at financials and non-financial companies, you will see a similarly very strong trend. A 17% year-on-year growth in revenue, almost a 59% growth in EBITDA, and a 245% growth in PAT. So I think what is important is that we cannot hang everything on the hat of liquidity. In my opinion, a large part of the resilience of the market has been the ability of our corporate sector to handle the COVID crisis very well, and the fact that earnings have surprised on the upside for the last 3 consecutive quarters. Yes, there is one trend which we have to keep in mind, which is that commodity inflation is starting to hurt gross margins. And the good thing is that the financial stocks of the banks have benefited from the COVID provisions that they made last year. And we are hoping that even despite the second wave, there is enough buffer that has been built by the financials that wouldn't have to take any significant incremental hits on their balance sheet because of the second wave. Having said that, I think in the fourth quarter, there was a very even distribution between hits and misses. But by and large, the earnings in the fourth quarter have been very, very strong. And just to buttress the fact, our portfolio earnings in Q4 were actually far stronger than the Nifty. That brings us to a very important topic. As each one of you would have seen, we have made a certain changes in the portfolio, and we've been talking about this in our monthlies, where we have slightly shifted the tilt in our portfolios towards cyclical stocks. Now, away from defensives. Now, last year was very different. When the COVID crisis first hit, nobody knew how long this is going to last. We didn't have any visibility of how the recovery would happen. And at that point in time, it was quite appropriate for us that we positioned our portfolios far more defensively. But as we saw a V-shaped recovery from November, December going into this year, and despite the fact that we've experienced a second wave, our feeling is that the economy should bounce back, and several sectors which haven't done so well over the past many, many years are incrementally likely to benefit from a very pro-cyclical fiscal policy, a very dovish growth-focused monetary policy, and I think there will be continuous support. On top of that, we will also see the benefits of some of the reforms that we've talked about in the past. And if you keep that in perspective, I'm very sure that there are several new sectors which in the past did not do well, which will start doing significantly well, which we broadly bucket into cyclical. So it's manufacturing, it could be exporters, it could be autos, it could be auto ancillaries, it could be metals, it could be commodities, it could be capital goods, so on and so forth. And also will benefit certain consumer discretionary sectors which got impacted substantially because of the lockdowns. And to buttress my view, this is not just a view out of thin air, right? If you look at the data, the EPS CAGR for defensive stocks between FY17 to 20 was 13%. Between 20 to 23, earnings is going to compound at 14%. So yes, there is a 1 percentage point improvement in CAGR. But if you look at cyclicals, right, the EPS CAGR for the 300 companies that we had for this sample was up 5.5% between 17 and 20. But between 20 and 23, their earnings CAGR is almost 28%. If you look at free cash flow to EBITDA, defensive had 72% of their EBITDA converting into cash flows in FY19, which in 20 will be 70%. But if you look at cyclicals, there is a huge, massive improvement. The percentage moves from 58 to 72%. And we believe if you look at the EPS upgrades, in the case of defensive, it is 3.5%. In case of cyclicals, it is 12%. The change in forward EPS for defensives is only 0.8%. For cyclicals, it's 22%. The change in free cash flow to EBITDA for defensives is actually minus 1.9%, but for cyclicals, it is up 14%. And change in debt equity for the cyclicals, it is improved by 0.33. What it means is that as the cyclical sectors improve, they are deleveraging their balance sheets. They are surprising on the upside when it comes to profitability. And also, the delta change in earnings is significantly higher. And therefore, we believe that there is a huge valuation gap between the cyclicals and the defensives. Yes, the defensive sectors have inherently an higher ROE. But as you all know, market moves on incremental changes. And I think the incremental changes are significantly better in cyclicals versus defensive. Now, does that mean that we are going to throw away all our defensives? The answer is no. We still believe that we will favor in defensives low NPA lenders. We have exposure to pharma. We continue to have significant exposure to IT. We have a bias towards exporters, but we also incrementally have now exposure to cyclicals where we have chemicals, we have turnaround lenders, we have a bit of metals, we have auto ancillaries, we have industrials, capital goods. And we believe that our portfolios are very well positioned for the next 2 to 3 years. So I think that our belief is that we have now positioned our portfolios to significantly outperform the Nifty from here onwards, as we've tilted away from sectors which may continue to deliver mid-teen EPS growth to sectors which can deliver in high 20s and 30s in terms of earnings growth. And the upside could be, if these sustain, then we could also see a re-rating in PE multiples in some of these cyclical sectors. So I believe that as we look at the data, what the data tells us, what we believe how the economy is likely to improve, we have also repositioned our portfolios. And mind you, while we have tilted a part of our portfolios towards cyclicals, we have been very, very mindful of management quality and balance sheet strength. So it has been done without compromising the quality of the balance sheets or the quality of the managements. So I believe if we can achieve a lower price earning multiple with a better earnings growth without compromising the balance sheet strength and management quality, we think that over the next 12, 18, 24 months, we are now very well positioned to outperform the benchmarks by a reasonable margin. And we continue to be bullish and constructive on the markets. We are not worried about the current levels of the markets as many investors are. And we have been advising investors that there is a clear basis beyond liquidity, which is leading to a very strong resilience and continued strength of the equity markets. I will just leave you with one thought. You tell me, we have in the last, forget the first COVID wave and the correction, but even post that, how much bad news have we thrown at the market? And despite that, if the markets haven't corrected, then they are telling us something. If we don't want to read those signals, it is our problem. The markets will do what they have to do. And I think that this continuous worry that investors have had for the last 6 to 8 months about market levels have proven us all wrong. And I think that we continue to be reasonably optimistic. Yes, there can always be bouts of volatility because of some macro news, because of events that happen. But on the whole, I see a very strong economic recovery over the next 2 to 3 years. And I believe that our markets will also move from strength to strength. And we are very well positioned to take advantage of that. With that, I conclude here. Thank you all for your time. Once again, wish all of you the best of health. Take care until we meet next time. Thank you.